Well, I greet you and welcome you to this tutorial where we are looking at system analysis and design. And majorly we want to look at the calculations that are done during economic feasibility studies. We understand feasibility to be a study that is geared towards determining whether the given venture, whether it's a business, anything, we're actually determining its viability. Is it viable in terms of resource utilization or consumption vis-a-vis what we are going to get out of that system? And so, in this, of course, we have been able to look at a number of things, moving from what we call the cost-benefit analysis, where you just weigh what is the cost of this in this domain, what is the cost of this system and what are the benefits of this system. That is what we call cost-benefit analysis. That is the point. Then the payback period is determining for how long will this particular project be able to restore, or rather to give us back what we planted in there. We can call it the seed, the capital. We have raised 100,000. For how long will we be able to realize that 100,000 back? Then the return on investment, this is of course it's expressed as a percentage or as a fraction of the cost vis-a-vis the benefits. You are looking at the return of the investment. And one thing to mark is that on payback, the shorter the payback period, the lower the risk. The longer the payback period, the higher the risk. The shorter the payback period, the lower the risk. The longer the payment period, the higher the risk. Then there is the net present value. You want to look at what will be if I'm told that I'm going to gain, this is done especially if you are taking maybe a product today and you want to pay over a given period of time on hire purchase. How do you determine, someone tells you that in 5 years from now, the value of your land will be 5 million. So how do you determine its present value? We want to work with it. We bought the system 10 years ago. What is its value today? So those are the things that I will be able to address here. As you can see, we have highlighted here that the foundational analysis that compares the total versus, that is the total cost versus the total benefits. That is what we are referring as the cost-benefit analysis. So this would touch on the tangible and also the intangible. The tangible are things you can be able to quantify, you can be able to measure, like the labor. You can be able to quantify that. If it is computers, you can be able to quantify. But there are things that you may not be able to quantify in terms of, like how can you quantify a factor such as maybe the emotion, how can you quantify stress? Those are things you may not be able to quantify, but you have to include them in this analysis. So that is the formula of computing that CBA. This is not CBA that some people know out there. No, it is given by benefits minus costs, and then you get net benefit. Net benefit is the same as cost benefit analysis. And here we have an example that we are given. And in this, we are told that a company is considering a stock management system with a projected lifespan of 5 years. The system has the following tangible costs. 1, initial software license. These are costs that you can be able to tell. So initial license would cost 50,000. Implementation and training is going to cost 20,000. Hardware upgrade is costing 10,000. Annual maintenance and support is going to cost 5,000. So you need to know which costs are annually and which ones are one-time off. The system has the following annual benefits. 1. Reducing inventory carrying costs at a cost of 15,000. Improved operational efficiency, labor saving at 10,000. Then we are talking of decreased stockouts at a Kenya shillings 8,000. Find the net benefits from this system. So you need to break down your work like this. What are the total costs? You realize that here we mentioned about initial software license at 50,000. We mentioned implementation and training at 20,000. Hardware upgrade at 10,000. And annual. That thing is annual, not not lump sums per year. And we are having 5 years, meaning that we will be using the amount of 5 times 5,000. Every year, 5,000. So for 5 years, it will be 5 times that. And so the total costs here would give us 105 if you permit, and of course if you do it. Then the total benefits would be, from what we had, 1, we got that the system reduces inventory carrying costs at a cost of 15,000, improved operational efficiency, that is labor, costs at the rate of 10,000. Then we have also been told that it decreased the stockouts at the cost of Kenya shillings 8,000. So we are supposed to find the net benefits. Remember, that was for 1 year. The costs, the benefits that we were given here are for 1 year. What about in 5 years? And that is why we are having this 5 here, multiply by, into bracket, the benefits in terms of efficiency, labor saving. We are looking at those factors. So when you compute that one, total costs, you get total benefits is 165. Then it means that the net benefit, which is now what we are referring as CBA, will be given by benefits minus total costs, and that gives us 165,000 minus 105,000, and then it gives us 60,000 Kenya shillings. So that is the cost, the benefits of that system, and therefore this is a very viable project to go on to. If you got the value as negative, then it will simply mean that that is not a best project to invest in, because it is not giving back, but rather it is taking away from the investor. So yes, that is how you compute your CBA or benefit cost. That is total benefits, net benefits. I want us to look at something else. And what we want to look at is what we call the payback. When you talk about payback period, it is simply the amount of time that is required for one to regain what they invested. If you invested 10 shillings, how long will it take you to get the 10 shillings? In business terms, we talk of break even. So we use this, of course, to assess the liquidity and the risk. And I had already told you that the higher the payback period, when I say higher, it means longer, then the risk in that business is very high. But when the payback period is short, then it means that the risks are also lower. Okay. The formula is given: payback period equals to initial investment, what you had, divided by the annual cash flow. What is coming in annually? What was your investment? If you had an investment, let's say 50,000, and annually you are receiving 25,000 Kenya shillings as the inflow of cash, then it simply means you take the 50,000, which was your initial investment, divide by your annual cash inflow, which is 25. Therefore, you get 2 years, and that means the project would simply take how many years? 2 years, and you're done in terms of repaying. Now let's consider an example here that a company here is considering a stock management system with an initial cost of 150,000. It is expected to generate 50,000 in annual savings through increased efficiency. Calculate the payback period. Very simple. Payback period is given by initial investment over annual cash flow. Here, this is very straightforward. You have your 50,000 as a money that was used as capital. Then it is expected to generate an inflow which is uniform of 50,000 per year. Therefore, initial investment over annual cash inflow would give us 150,000 divided by 50,000, and that gives us 3 years. And that is the amount or the time required for this particular project to plow back the money, to return all the capital invested. Let's look at this one now. What happens in a situation where perhaps you have cash inflows that are not, when we say consistent, it may make sense, but rather I'm looking for a better term. When you have cash inflows that are not regular, that is, they are irregular. Let's say today you have 10 shillings, tomorrow you receive 15, the other day you receive 30, the other day you receive 2 shillings. That is irregular. So, consider this case here. If the annual net cash are 1, 20,000, year 2 we have 30,000, year 3 we have 35,000, with an initial investment of Kenya shillings 80,000. So the question here is, what is the payback period? How do you then compute when you have irregular income? So what you do is that you need to compute what you call cumulative amount per year. Like year 1 would you begin with what you have. Then year 2 you will take the year 1's inflow plus the year 2's inflow. Then you have that computed. Year 3 would mean you take the year 1 plus the year 2 plus the year 3. In other words, just take the year 2 cumulatively plus the third year. Now in this case, when your first year you have 20,000, your second year you have 20,000 plus 30,000 as had been highlighted earlier on, and that gives us 50,000. In year 3, when you do the accumulation, you realize that it is going to surpass the amount of 80, because we are going to get 85. And that is to mean that this project is able to pay back during the period between the second year and the third year. But the exact point is not known. So how do we determine? To determine the exact time is that we will now need to write first the 2 years that we know that the project will be paid in 2 years. Then we take the investment, the total of the investment, minus the cumulative of the years that would have been paid, and they are not yet done. And then in that case, you take 80 minus 50. Then you realize that you need 30,000. So when you need 30,000, you take that 30,000, divide by the amount in that year, so that you get the fraction. And in this case, you have 30,000 over 35,000, which gives us 8.6 years. When you compute or you add them, you now have 2.86 years. And that is how you calculate the payback period for irregular